Channel pattern trading, the smart way to make money. Channel pattern trading is one of the easiest technical analysis techniques to implement, and the good news is that on average, most financial instruments will trade within a price channel at least 20% of the time. In fact, when analysing charts, rather than drawing trend lines, your first choice should always be to look for a channel, and if you can't see one, then settle for a trend line. Channel trading can be a very powerful ally when you employ the leverage that comes with options. Using various options strategies, you can make money from the price direction of a stock or other financial instrument, irrespective of whether it's going up or down. But there are a few things you need to be aware of. Taking heed to these will potentially save many losing trades. Sideways channeling stocks can present themselves at any time, but in many cases, they precede a major shift in direction, such as a swing from a bull to a bear market, or vice versa. This being the case, it is important to remember that at some point, every channel pattern will end, and recognizing the signs in advance will prevent bad trading decisions. It also means that identifying a channel as early as possible allows you to take advantage of them before they end. Channel patterns can take three forms. Firstly, we have sideways channels, defined by two horizontal lines. Then there are uptrending channels, also known as ascending channels. And finally, we have downtrending channels, also known as descending channels. Take a look at this chart of mining company BHP, where we illustrate how all three channel patterns present themselves. If you look at the notes on the chart, you'll also observe some warning signals that the channel was about to end. Using channel pattern trading to profit with options. We can see from the chart that channel pattern trading is based on identifying two parallel lines. To the left of the chart, we see a descending channel. This is followed by a sideways channel that precedes a price action reversal, so that the stock now trends north into an ascending channel pattern. As the ascending pattern begins to fail, the warning signal presents itself when the last high point fails to reach the top of the channel. It warns of weakness, which is confirmed when, to the right of the chart, the price fails to bounce off the lower trend line and breaches it instead, plummeting down to around the same levels as the bottom of the previous sideways channel. Notice also the warning signal at the end of the sideways channel. The final price trough failed to reach the horizontal support line, warning of a potential end to the channel. Sure enough, shortly after, it thrust through the upper resistance level and continued north, then pulled back and forth a few times to form a flag pattern before moving north again. So let's talk about waiting for validation. One of the worst mistakes a trader can make is entering a position which anticipates a bounce from off a channel support or resistance line. You should always wait for validation. What do we mean by validation? If you look to the far right of the chart, an example of failed validation is given. Validation is a price move which breaches the short-term trend line that you would draw within the channel. It should preferably be accompanied by supporting volume and a decisive-looking bar or candle. This validates the short-term price reversal and provides an entry signal that you can be confident about. Trading channel patterns. You may have heard the expression, "The trend is your friend." This applies just as much with channel pattern trading as it does with swing trading. In fact, trading ascending and descending channels are just another form of swing trading, only the price moves are more defined. When trading an ascending channel, it is always safest to only trade validated reversals bouncing up from off the lows. Trading reversals from the peaks means going against the trend, and while this can be done, it also carries more risk. The reverse applies to descending channels. But all the while, you must be on the lookout for potential reversals, because you know that all channels end at some point. so pay attention to how long the channel has been in progress. Some aggressive or experienced traders may try to trade minor swings in the market, but this is not recommended for beginners. If you are new at this, only trade with the trend. When drawing your upper and lower trend lines, you don't need to strictly adhere to the highest and lowest points. The most valid trend lines are those that have the most touches of peaks or troughs. You'll notice, for example, that in the new ascending channel in our chart, that we ignored the first high point because there were more touches in the price consolidation area just below it. On the other hand, if you have to force your channel to appear by drawing strange lines, you are probably working too hard and looking for something that doesn't exist. Option trading channel patterns. Some very successful option traders who I know will only trade channel patterns and a couple of other setups because they consider them high probability trades. If you prefer simple long options positions, you trade put options in a downward channel and call options in an upward price channel. When choosing your options strike prices, veteran trader David Valieris, in his Winning Trade System course, recommends that when using simple long options strategies, you should prefer in-the-money options with a high delta. You should also know how to interpret the volume bars on your chart. This method is a very cost-effective way to trade channel patterns because it minimises brokerage costs while providing a strong buffer should the price action go against you. So why not start looking for channel patterns on your charts? Try different time frames. You might be surprised how many you find.